Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Alicia Levine, a good friend of the show, brings prodigious quantitative abilities at BNY Wealth, head of Investment Strategy and Equities. Okay, let's go Matthew right now. Stochastics is really ugly when you got the sharp turn. It's really hard to manage the turn, to do the turn, execute the turn. Where are we on the turn? Are we going into it? Are we at the apex, or are we coming out of it where they have some stability, a vector trajectory to a lower rate?
So we're in the middle of it because the turn really came in December. That was the turn.
Okay.
Right.
Last December.
That's
8 months ago. What took so long?
No, well, the market's up 19% year to date. So the turn happened in December when the Fed pivoted from a high for longer to we're cutting. So we're here. The interesting issue for today is that we're disappointing somebody. We're either disappointing the 25 folks or the 50 folks today because the market pricing is right in the middle.
Take it from your equity space over to the BTMM screen. How is this going to shift the gazillions of dollars BNY observes in short-term paper, money market funds, all the fancy Ira Jersey inward stuff?
So the interesting thing is if the Fed's at 25, then the hiking cycle could go longer, but it's shallower. I mean, the cutting cycle is longer but shallower. So in other words, you get 75 this year and not 100 this year, but the paper is already moving, right? Because short rates are now lower, and they've been lower all year, which is why when you ask where are we in the cycle, we are in the middle of it because the pivot is what caused all this to happen. We got delayed by hotter inflation prints earlier in the year, but essentially the path that the Fed laid out in December is happening now, starting in the summer.
All right, so given that backdrop, we're going to have the Fed start cutting today. It'll be on some cadence, some pathway over the next 3 to 4 quarters. What do we do here? I mean, I've already got the 2 years moved from 5%, just a cup of coffee goes, Tom Keene would say, to now we're at 3.6%. So where do we go from here? Right.
So look, I think that the 240 basis points that's priced into the bond market right now through the end of 2025, that number of cuts, we think that's a lot because actually we think the U.S. economy is in pretty good shape. So there could be some sell-off in the bond market because when there is a recognition that is just too many cuts. I mean, 10 cuts is a lot for where the economy is right now. But overall, if you look back at history, when the Fed starts cutting, you want to be in the bond market, right? So you may have volatility around it, and those days could be great days to enter into a position or to add to a position. But overall, when the Fed starts cutting, you're with the Fed here, and you want to be in the bond market, and you want to be out of cash.
You got a mathy top-down feel versus a lot of shops where they got huge walls of security analysts telling them what to do. Do you just assume corporations will adapt whatever they're handed by Powell, and that we will generate high single-digit, double-digit earnings growth? That seems to be the optimist conviction right now. Do you share that?
I do. We do share that because ultimately you'd rather have a strong U.S. economy feeding into earnings, driving the stock market.
I got a 5% nominal GDP. I'm talking, this is like anti-American. Alan Meltzer at Carnegie Mellon will roll over in his grave. We're talking 50 beep cut off 5% nominal GDP. Discuss.
Okay, so real Fed funds rate is over 2% now. So they have to start cutting. So we think they could go 50 today in a world where they were simply just looking at where the real Fed funds rate is. The problem is there's the whole communication piece, and the Fed went dark, at the end of September 5th when that labor report came in that morning, not enough time to digest it. And so they're likely to do 25 simply because the market's too offsides. Like there's no conviction in the market, and therefore the Fed can't be convicted on it either, although the path is convicted, meaning they're cutting. Right, and the cutting path is pretty clear.
So this is like explaining to your kids that a C doesn't get it done.
A C doesn't get it done, exactly. So on the equity side, Alicia, where do you want to have exposure here if this Fed's going to be cutting and maybe cutting aggressively? Where do you want to be here?
Look, you see it already. REITs have been a standout. Financials have been a standout. So the conversation we have as well historically, when the yield curve normalizes and the Fed starts cutting, equities sell off. Well, they do that when the Fed starts cutting into the recession, right? Or into areas of true economic distress or financial distress, and then you get the recession. Yes, equities sell off even as the Fed is cutting. But if you go back to 84 or 95, when the Fed cut into a soft landing, you saw financials rallying and the stock market rallied. We think we're in that period.
Right.
We think we're in that period. Now, we've already had a 19% rally in the market, so there's plenty of time here for consolidation, a little excitement around the election, consolidation. This is typically what happens seasonally anyway, this time of year. Throw the election and you could go through October. But ultimately, the fundamentals are no recession, no earnings degradation, market goes up.
Are you concerned about this election, or do you just kind of put it aside and say, this market's bigger than that?
So we tell our clients to put it aside.
Put it aside. Okay.
Put it aside. Because, in the end, whatever volatility there is around it is usually short-lived because there is an answer.
Yep.
I think that if there's uncertainty going into January, let's go back to the 2000, stock market sold off 12%. Okay. So, and the Fed had to cut twice. So could that happen? Maybe. Right. But ultimately, we put it in a box and we look at the long term, and the long term is, America is the place of innovation and new, capital creation and new companies. So this is where our clients' money is, and that's where we want to be invested. So I don't worry. I'm not a trader. We don't worry about what's happening in the next 3 weeks. We worry about creating wealth, preserving wealth, and where we should be creating.
So where are the shadows in the market right now? If you take the cross moments, and I'm going to, pick on skew just because that's whatever, the fancy quant people talk about. They get, they go to Chicago and they go skew. Good, use that. You get a job. Okay, the skew, the dynamics of the market now, if I'm not trading, but I'm looking at 1 year, 3 year, 5 years, to me the dynamics are actually pretty healthy. If a company raises their dividend 10% and does a share buyback, the stock goes up. Makes sense. To you, is it a normal market?
It's a normal market.
I agree.
We're in a normal market. I really think 95 is the analogy here. I think we're in a place where we had some slowdown earlier in the year that looks to have stopped. Look at retail sales yesterday. Atlanta Fed GDP now is back up to 3%. Yep. So we know it's not exact, but it's directionally correct usually. And so it just feels like we're in a very good place.
Great.
So I'm worried. So the labor market is showing clear signs of slowing. I'd call it into a normalization, but that normalization seems to have happened earlier in the year than we thought. Because, the revisions have been pretty dramatic. So, the Fed can start. It's time to start. It's just time to start cutting.
And so, again, I'll ask the simple question of the day, 25 or 50. What should they do, and what do you think they're going to do?
So I think they should.
Better you than me.
Yes.
I think they should do 50.
Okay.
Because I think they're at least 200 basis points. Real rates are at least 200 basis points, and that feels too tight. And we're definitely squeezing the lower quintile consumer, and the housing market is all but stopped, right, because of mortgage rates. So that should loosen up. They should do 50. There's plenty of room here to cut. But I don't think they will, because I simply think the market's too offsides. There wasn't enough communication about it before they had to go into their dark period. And I think they'll think the prudent and best path not to roil the market is to go 25.
Lisa's been medicating me with Tang since 5 a.m. I'm not giving my opinion, folks. Everybody's saying, what do you think? What do you think? What do you think? We were just going to listen to people like Alicia Levine.
Exactly.
50 beeps, but they'll go 25.
And it's okay. And it's okay. I don't think it roils markets either way, although some parts of this trade are going to be disappointed. Last week, S&P up 4%, NASDAQ up 6%, going into that 50 basis point probability going higher.
It's like therapy.
Yep.
You know? Dr. Alicia, thank you so much. Alicia Levine, BNY Wealth, Head of Investment Strategy and Equities. Joining us now for a 3-hour conversation, Jason Furman. He's at Harvard University, of course, teaching Act 10. And I can't say enough about your need to follow Professor Furman on Twitter. It is the adult feed out there on economics now, linking in policy and, of course, the uproar of his op-ed supporting Harris, da-da-da-da-da. We're not doing that today. He's got the best annualized inflation metric of, I think it's 21 data points to give you the vector on inflation. We're not doing that today. We're doing this idiocy of this meeting today in our communicative strategy. Jason, you partition monetary policy into two tunnels. And tunnel one, where we're on right now, is completely subjective to rates. And in Twitter, you have this beautifully stated, as only you can do. The policy you get from an inertial style Taylor rule. Discuss that for mere mortals. We're rule-based. We're looking at inertial force to stagger back to once we what knew. Is that basically what we're going to see at 2 o'clock?
Yeah, so great, Tom. You know, there's no award that I prize more than when I get the tweet of the day from you. I get so excited. So, yeah, the way the Fed conducts policy, I call it no reversals. They're very, very, very averse to reversing themselves. They want overwhelming evidence before they start to move. So what does that mean? Let's say the Fed funds rate a year ago should have been 5, and then it should have been 4.75, then it should have been 4.5. They don't move. They wait until it should be something like 4, and then they start to move slowly towards it. That means that if they make a mistake and it turns out, oh no, it doesn't need to be 4, it needs to be 4.5, they can call off the future cuts rather than have to reverse themselves and raise rates. That gives a certain inertial predictability, which is nice, but it also guarantees that they're behind the curve and means that their words just matter a huge amount.
Volcker and Greenspan didn't have this. Paul, I literally remember the joke that if Greenspan, was it peanut butter and jelly or a ham sandwich in his briefcase when he went into the Eccles building on Fed Day. Professor Furman, are all the well-meaning people at the Fed victims of the modern media frenzy, including you pounding them out on Twitter?
Look, I'm not sure. I think this is the paradigm we've been in for at least a decade now. We got into it in an even stronger way because of forward guidance, which when it first was launched during the financial crisis was important. It was all about lowering real interest rates by promising the nominal rate would stay lower for longer. You don't have that consideration when rates are above zero, when you're not in a financial crisis, but it's where we are. It's how the market operates, how the media operates, how the Fed operates. I don't think they can change it this afternoon, but it is worth giving some serious consideration of shifting to an alternative approach where you set rates based on all the information you have, you do your best guess, and that means at the next meeting, you will always be as likely to raise rates as to lower them. So you don't have the cutting cycles, you don't have the increasing cycles, you have something that, and I need to find a better word for this, but statistically is equivalent to a random walk.
Jason, if we had a dissenting vote today, would that be newsworthy to you?
I'd love to see a dissent. There's 12 people voting. They have different views. They don't all think exactly the same thing. It's healthy for people to express those different views. So I will be newsworthy because it's not something that's happened a whole lot under the Jay Powell Fed, but I think it would be welcome.
Once the Fed does begin cutting rates, Jason, is there a preferred path you'd like to see them take, whether it be kind of a measured 25 basis points every period or every meeting or something maybe a little bit more nuanced?
Right. I mean, I have this like crazy fantasy that they'll cut by 37.5 basis points today. And then we can all call the Fed funds rate 2 without talking about the range or the midpoint of the range anymore. And by the way, it splits the baby between two things. Absent that fantastical outcome, I lean towards 25. I think up until the last few days, That basically is what their forward guidance, such as it is, set the precedent for. But 25, with the expectation that they're continuing to operate at the same pace
Jason,
for the next couple of meetings.
I get an A.
But that's not a strong view.
Jason, I get an A in Ec 10 at least for one day, because I was saying split the difference as well. I mean, back to Arthur Burns, I actually went back and looked, Jason, not Bowman recently of the dissent, but there have been numerous times where we've done something in between 25 and 50. I agree with you that, splitting it today would be charming. What would be the reaction of the Fed and the reaction of the markets to an in-betweeny 3/8?
I don't know. I don't know if there's computers out there that are programmed to do 25, 50 and they blow up when this happened. I assume that's not the case. I'm not in the plumbing of this stuff, but people are going to be disappointed. People are going to be surprised no matter what they do. At 37.5, you are minimizing the disappointment and surprise. But really, my passion stems from just hating to talk about this range. It just adds extra words every time you talk about the Fed funds rate.
You can come back. Paul, get in here again.
Jason, what's your thoughts of this economy here? Has this Fed waited too long? And because there's a lot of folks that'll point to recent real-time data saying, boy, I think this economy is kind of rolling over a little bit. Are you in that camp?
Look, the economy grew at 3% annual rate in Q2.
Yep.
It looks like it's going to grow at 2.5% to 3% in Q3. Consumer spending is crazy strong. I don't think there's a huge hurry to get to this. I'm glad they're doing it today. It makes sense. If they had known the jobs data, they would have done it in July if that meeting had happened 2 days later. But this, to me, is about the right timing. I think there's still a real asymmetry. Inflation can be very, very costly to squeeze out. The longer you have it, the more costly it gets. And that was the risky side of the mandate as recently as 6 months ago, and they were correct to think that.
Jason, we should stay on this because it's the news of the moment, but I got to go bigger and larger, and you've been writing up a storm about our future policy of these two candidates who seem to be both devoid of policy. Remind our audience coast to coast of the harm of tariffs in America.
Yeah, it's just crazy that we're actually contemplating putting a 20% tariff on every country in the world on every single thing they make. That'll raise prices for American consumers. It'll raise inflation. If the Fed doesn't look through it, it will also result in higher interest rates. It won't reduce our trade deficit at all because a combination of exchange rate changes and or foreign retaliation will happen, which means instead we'll just get less imports and also less exports and all the jobs supported by exports, all with no negotiating theory at all. What are we trying to get from Australia? Are we trying to bring the ballpoint pen industry back to America? It just makes no sense at all.
We'll probably have to export Wolfers of Michigan back to Australia. That's probably what'll happen. So, Jason, given the theme on tariffs, let's say the former president wins, and he has to go out and find somebody like you to run economic policy. Now, let's say Glenn Hubbard, I'm just picking a name out of the blue, folks, the wonderful Glenn Hubbard of Columbia is selected by Mr. Trump, President Trump's second term, and he goes in and he has to do this, and Glenn's doing it for love of the nation and all that. Do you have any confidence that right-leaning, conservative, measured economists can convince President Trump of a more measured path?
Look, it would be a wonderful sign if, in the case that Donald Trump gets elected, he picks someone like Glenn Hubbard to advise him. That's not the type of people he's surrounding himself with right now. And, he doesn't need to listen to them, even if he is. His trend over the course of his first term was to listen to more extreme and irresponsible voices over time. And I worry his second term would be an extension of that. But, with him, you never know. So,
hey, Jason, you published in the Wall Street Journal 2 days ago.
He says.
Yeah. Jason, can you summarize the op-ed piece you put in the journal, you published in the journal 2 days ago, putting up the two candidates and maybe what their economic policies look like? Just summarize that for us.
Sure. Look, they're both economics majors. And economists are all pulling their hair out because we're hearing all sorts of things like blocking investment coming into the country from Japan and, price gouging and things like that. But I do think you need to quantify. You can't just do plague on both your houses. And the quantification is quite different. Trump, much, much, much higher tariffs. His tariffs would cover 200 times more of the economy and imports than Harris's would. On the deficit, I add up Trump's proposals at more than $5 trillion. Harris's, in the worst case, 1.5 trillion, but it depends on whether she fills in some details and how she does. And then finally on the Fed, I have complete faith that Harris would do the same thing that Bush, Clinton, Obama, and other mainstream presidents have done. Donald Trump is a real tail risk to the Fed in terms of how he handles them.
Jason Furman, thank you so much for joining us today at Harvard University, teaching Ec 10 after ManQ and others. Jason Furman, of course, on this Fed Day as well. Paul, there's something going on here. Sure. You're not policing the interns. This is the second guest this week where we've got to open with the Texas Longhorns. What in God's name is this about?
They are for real this year.
Paul Knopp joining us now with some real substantial effort at his Austin, Texas. What is going on with Longhorn football? I mean, what's the Kool-Aid down there?
Well, we're really proud of our team, but I think, Tom, the message is take it 1 week at a time.
It's fun.
It's fun. It's fun.
I want the Cotton Bowl. I want fighting Texas Aggies Longhorns Thanksgiving Day at the Cotton Bowl.
That would be good.
Everybody would watch.
Yeah, that would be good. I'm a product of an age when the Southwest Conference was a big thing.
So. It was. Your show was a big thing. Here, we are thrilled you're here with KPMG. And I got to ask you a couple industry questions before we get to your wonderful CEO survey. My grandfather would have adored you because you came out of audit.
Right.
What's the problem with the consulting side of the business right now? Guys like you are the meat, the potatoes, the oxygen of the system, and there's this incredible sector tension between audit and consulting. How do you fix the tension?
Well, so we have a multidisciplinary model. We have audit, tax, consulting, and deal advisory strategy. We think that model is absolutely fit for purpose. We don't feel tension between the two sectors within our business. What I would say, Tom, though, is that there's some softness in consulting, and there has been for about 18 months, with more caution around corporate spending. But what we see is real demand when it comes to transformation. So particularly technology transformation, and generative AI is feeding some of that right now. So we feel really good about the prospects of the consulting business long term. But at the end of the day, that business really helps our tax and audit business to succeed in the market.
All I ask is ChatGPT helps me with debits and credits. It hasn't worked out so far.
Debits
Paul,
to the left, credits to the right. That's what I remember. All right, Paul, you guys at KPMG, you talk to everybody. I mean, on your Rolodex, which kids don't even know what Rolodex is, every CEO of every corporation around the world. And I know you guys survey your clients.
We do.
What are they telling you about some of their biggest issues or challenges right now?
Well, there's no doubt that cyber is a big risk, and generative AI is causing that risk to evolve over time. Geopolitical complexity is at the top of the list and has been for almost 2 years now. And then political uncertainty is really high up there too, particularly around what's going to happen in Congress with the TCJA expirations, almost $4 trillion of tax provisions expiring at the end of next year. Those things are really top of mind. A big challenge, though, they cite too often is making sure that they embrace and embed generative AI in their businesses. Business leaders believe it's going to be truly transformative, but it's probably more in the time frame, Paul, of 3 to 5 years from now. Your companies have to make sure they have their data right, the quality of the data, the right governance around it, and make sure they have their employees adopting it and well-trained on it.
On the consulting side of that at KPMG, how do you help people not throw money into the wind? How do you make an efficacious expenditure in this newfangled AI?
Right. So you start with making sure you have a trusted framework for AI, because you're going to lose credibility really quickly if you come out of the box with something that's not safe and ethical. And then you move to talking to your clients about use cases. Where can you put generative AI in your business, AI in your business, typically, Tom, it's been in the area of customer experience very early. Companies thinking about how you interacted with your customers with generative AI. But we're also seeing it definitely impacting the speed of development of software, of
That's
coding
what I
software.
Hear. Coding is
Absolutely.
the heart of the matter.
Absolutely. And then because of its predictive and analytical capabilities, it's very powerful in finance and accounting too. So we are definitely talking to clients moving from not just use cases, but actually they're operationalizing it.
And this is where you say, and when we consult, we say, of course you need a Bloomberg terminal.
Absolutely.
You're there.
Exactly.
Absolutely.
So cybersecurity, I kind of feel like, we talked about, it just seems like the growth story that just keeps on giving. I've not spoken to a CEO who is not increasing his or her investment in cybersecurity. I guess the question for a lot of them is, how do you do it smartly? I mean, I can't go out and just buy a piece of software off the shelf and say I've dealt with my cybersecurity issues. How do you do it smartly?
Right. Well, you certainly have to talk to a lot of different stakeholders and constituencies to make sure you get it right. The risk is evolving. So as I mentioned earlier, these deep fakes that have been that are emanating from generative AI and AI are sort of new on the scene the last couple of years. And so because of the continuously evolving nature of cyber crime and the criminals are adopting different techniques, you have to be ever vigilant. Awareness is really crucial as a preventative measure, making sure that you prevent the cyber crime from happening in the first place. And then just making sure that you're working with the right technology providers to monitor and ensure that you're capturing these threats before they become reality.
Right. I want to talk about the real headache at KPMG is getting and keeping the young troops and the glorious skill of accounting. Let's start with the why. Why all of a sudden is it hard to find audit people like you were years ago out of University of Texas?
Yeah, there's been a precipitous decline in the number of students going to college, number one, but then certainly going into accounting. So it's a real challenge. We are certainly as an industry and as a firm trying to entice and tell our story about the long-term benefit of an accounting and auditing background.
What's entry for non-CPA accounting? Kid green out of school, not KPMG, but just as a general industry statement.
Yeah, so it would range from sector to sector from anywhere from $60,000 to $100,000+ in that range. Coming out of college.
And then they get on CPA track.
You're certainly a important asset if you have a CPA, and that's something that is a declining number of them.
So
right
where
now.
is that compensation level? Right.
So that compensation level is sort of built in and expected that you would achieve that status, but once you achieve that status, you can expect your compensation to accelerate.
You're not going to give me an answer. Come on, it's Bloomberg surveillance. Give me a number to the penny.
The kids come out of college, say, with their accounting degrees, and they basically have their CPA.
Yeah, that's what I was going to say, Tom, is that when they come out of college, they typically within 1 to 2 years have their CPA. It's sort of expected
and
they will get it.
And you're paying them $100,000?
Well, so at certain levels we are, yes, and at certain markets we are. So you're obviously going to have something different in New York than you're going to have in a middle market.
And do you still send your consulting teams and your audit teams on site, or since the pandemic, is everything remote now?
So no, it's hybrid.
Okay.
It's definitely hybrid, and we're traveling a lot more. I'd say on average we're back in the office 2.5 to 3 days a week with a hybrid, flexible approach.
I got 20 seconds. We got to make some news here. Nobody cares about today. There's nothing going on this afternoon. Paul Knopp, just simple. Are you going to 5 days a week like Amazon?
We have no plan to do so. We are planning on optimizing our hybrid environment right now.
That's the world.
And try to make sure that
give his entourage in the control room. Would you give him some Tang so they'll calm down? We got to go. Paul Knopp, this is great. When the fighting Texas Aggies beat the Longhorns, come back. That's all I got to say. The Chief Executive Officer of KPMG. Thank you so much. Good morning, everyone. Your daily look, the front pages, the Lisa Mateo hour. Is your report today Fed free?
It is Fed free.
Yes. Okay, good.
we go. What it isn't free of, we've been talking a lot about sports, college athletes getting paid, right? Well, it looks like we've figured out who is going to be footing some of that bill, and that would be college football fans. This is University of Tennessee. They're adding a 10% talent fee to 2025 football tickets that will go toward paying the players. It was made an announcement in an email to fans. If the athletic director said, hey, we want to be a leader in college sports, that means we want to be a leader in revenue sharing. 10%, though, only a portion of that cost. The university told Business Insider that talent fee is going to cover about 33% of that total cost. So now fans have to be
pro sports.
And there's something called the collectives, which are basically groups of a collective. Each university has a collective or more than one collective, which are just groups of boosters who pool their money to help fund NIL.
Educate me here.
Which is, I think, the real scary part of the whole thing.
Educate me at Tennessee. They've got D1 this, famous, football, basketball, whatever. They've got, I'm going to say, field hockey.
Right.
Do they get paid?
I don't
That's a
know.
good question.
And if they do, it's de minimis. If they do, it's de minimis. But, for example, women's gymnastics, some of those athletes are getting paid a lot because they have huge social media platforms.
Right.
And they're making tons of money.
The social media is part of this?
Yeah, absolutely. So the kids are figuring out a way to build their brands.
Don't ruin my week. Is Tennessee still in the SEC?
Yes.
Okay.
There you go.
Still, life goes on.
Right.
Next.
Oh, this is going to fire you up. Okay, so a new study shows that younger adults, more of them, are heading to TikTok for their news updates. Sure. Yes, this is from Pew Research. 17% U.S. adults say they regularly get news from the site that's owned by China-based ByteDance. We've been hearing a lot about it. That's a five-fold increase from 2020. The most likely to turn to TikTok for news, those who are between the ages of 18 and 29. 39% of them say they regularly get news from the app. I have to say, my young one, every time he has a news update and he sends me a little text and it's always a TikTok. I don't understand.
Are they accurate though?
Are they accurate?
Do you think they're accurate? Are they from reasonable sources you would deem?
Sometimes, but other times I'm like, just go to the original source. Like, what are you doing? And your mom's a journalist. Why are you sending me TikToks?
Exactly.
I looked at it for 2 hours, folks, total. Like, downloaded the app, looked at it. And I really wonder, just not to pick Bloomberg, but say the New York Times, are they going to distribute through TikTok? I just don't see it. I can't get there.
Don't know.
A lot of people have the TikTok. President has a TikTok, yes.
Yeah.
I don't know.
We'll have to see, though. I mean, again, TikTok is it's with the courts right now.
It's going through a lot right now.
Yep.
Yeah. It's a big battle.
Next.
This one stuck out to me because I love the fall. I'm a leaf peeper, okay? So this is from the Boston Globe. The lack of rainfall in most of New England over recent weeks, it's going to affect the timing, the peak season. So the peak season is coming earlier than before. Okay. In fact, they're saying it already started in northern New England. At the same time, the color is not going to last as long. So if you want to see the colors, you should go now.
Okay.
and up your plans. The best places to watch the color: Western Massachusetts, Central Vermont, Western White Mountains in New Hampshire. So I'm a big fan of it. I'm going to be heading out.
Are you? See, I just think Jersey's got great foliage. I mean,
you do, but we don't get it first.
Yeah, but you get it the first week of December.
Right. Okay. All right.
We're a little behind the ball.
I just look out my window and I got great foliage. I'm good.
It's a big deal. It's actually really important tourist dollars for a lot of poor parts of northern New England. It really works out.
They do. Okay, so we were talking about the Fed, right? Big decision coming later.
I
Everybody's waiting
Fed
for
free.
it.
No,
okay,
wait till
we are.
continue.
This is
Because
gonna take a
guess
big
what
turn.
comes after the Fed? Later tonight. It is the debut of the Golden Bachelorette. Everybody's
Mrs. Keene mentioned this
talking
to
about
me.
it. She did. See, okay, she's a fan. It's Joan Vasso. She is school administrator, Rockville, Maryland. She's 61 years old. She's a grandma. She gets her choice of 24 men.
Nice.
24 men are going to be out there. She's going to pick who she wants to be hooked up with. But she's a widow. Like we said, married 32 years, 4 kids. She's looking for someone outgoing, someone courteous.
6'5", finance guy,
Blue eyes.
Blue eyes.
Because last year it was a 72-year-old
Yes,
grandpa.
it
He dated
was.
22 women on TV. Now it's
Now it's on
switched.
to
Now it's on.
Yes,
okay,
now it's on.
awesome.
And she was actually part of The Bachelor, but she had to leave early for a family emergency, so they picked her. She's coming back, and the guys are between the ages of 57 and 69. So it should be interesting. I mean, she's saying that. Oh, she also wants someone who wants to help her with grocery shopping and yard work because she doesn't like doing that.
I qualify.
Bingo.
Is it successful? Is the show like
it is a huge the Golden Bachelor was a huge success for ABC, so that's why they're hoping that this is gonna kind of
Lisa Mateo, I can't think because of the Golden Bachelor. I'm thinking of Lisa on the show, but that would be Lisa Mateo. Thank you so much for the newspapers today. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.